LYC and KPJ Healthcare operate asset-heavy models, tying up roughly 75% of their total wealth in long-term infrastructure like hospital and medical equipment. This high operating leverage limits short-term flexibility and increase impairment risk. However, because healthcare demands remains inelastic, this asset-intensive structure successfully built a highly stable, long-term operating base for both companies. On profitability, their paths diverged. LYC Healthcare suffered early net losses and drastic revenue cash down to 4.26 million in 2025. Yet, healthy gross margins above 44% still pushed them back into profitability. In contrast, KPJ Healthcare delivered steady, double-digit revenue growth driven by rising patient volumes and excellent expense control. KPJ proved that essential healthcare service yield highly sustainable net margins.
Operationally, most companies are performing well. LYC Healthcare showed strong improvements, boosting its asset turnover to 0.75 times and reducing collection times to 68 days by 2025. KPJ also highly optimized its large asset base, maintaining steady turnover and fast 67-day debt collections. Looking at the DuPont analysis, KPJ is in a very healthy position. By pairing stable profit margins around 9.4% with moderate well-managed leverage, they achieve a solid return on equity of 30.4% in 2025. Conversely, LYC is caught in a leverage trap. While they are operationally efficient, their profit margins remain negative because they drastically increased their financial leverage, surging to 5.91 in 2025. This debt acted as a double-edged sword, magnifying their losses and driving ROE down to 68%.
I will talk about the AIMAN Z-score analysis. From this analysis, we can see clearly difference between LYC and KPJ. LYC Healthcare record negative score declining from negative 0.12 to 0.79, indicating that company remain in financial distress with a weak liquidity and increased leverage, although lows have narrow financial risk, remaining high risk. In contrast, KPJ Healthcare improved in Z-score from 2.86 to 3.24, remaining in the safe zone through the period. This is supported by improving liquidity, declining debt, and strong operating cash flow. In conclusion, LYC continues to face significant financial distress while KPJ maintain the stability and healthy financial position. Thank you. Okay, now I will talk about financial forecasting. From our POV point of view, we see that the LYC will be recover from their loss and KPJ will maintain stable on the level of profit without any expected loss, and we will see LYC will become revenue in 2027. We'll make a revenue in 2027.
So now, I will present about corporate governance quality for both companies. For J-Corp, the board structure shows a clear separation between the independent chairman and the group CEO. This will help to ensure the proper checks and balance within the company. So the audit committee is fully independent, consisting of 100% independent non-executive directors. So this will improve the transparency and reduce the bias in financial reporting. So in terms of risk management, the ARNC oversees the major risk, capital expenditure, and liquidity during the restructuring period. So this will help the company to manage the financial challenges effectively. For BKP, the board has a good mix of skills, expertise, and diversity. This will support the company's strategic growth and decision-making process. So the audit committee consists of 4 members with accounting expertise. Their knowledge will help to strengthen the financial monitoring and compliance. Regarding the risk management, the board actively oversees the risk management, sustainability, and governance matters to ensure the long-term business stability. So overall, good corporate governance is important because it will increase the transparency, accountability, and investor confidence in the company. So that's all. Thank you.
My name is NABILAH binti AZMI. I represent Comprehensive Cooperation and Trend Analysis. We contrast LYC and KPJ. In terms of trends, both show positive operational momentum. LYC is narrowing its losses over 4 years time series, while KPJ is growing revenue and profit over 3 years. The critical divergence, however, is risk. LYC faces high financial distress with its negative Z-score, confirming its GN3 restructuring status. In contrast, KPJ maintains low financial distress. This comes down to intra-company dynamics. LYC's strong operating margin are completely wiped out by the heavy interest burden, while KPJ high operating efficiency successfully offset its fixed asset base.
In this section, we evaluated whether both KPJ and LYC properly identified their operating segments, disclosed the basic identification methods, and reported key financial metrics such as segment revenue, profit or loss, assets, and liabilities. As shown in our compliance checklist, both companies satisfy all major disclosure requirements, including providing a clear reconciliation back to the primary financial statements. For major customer information, both entities mark it as not applicable because neither company relies on an individual customer that exceeds the mandatory reporting threshold. KPJ Healthcare Berhad provides exceptionally clear segment reporting that follows their internal management structure, which greatly improves financial transparency for investors. What is highly commendable here is LYC Healthcare Berhad. Even though they are currently under GN3 financial distress, they still fully comply with MFRS 8 by accurately disclosing their reportable segments, performance and required reconciliation based on management reporting. For this standard, both entities explicitly disclose the Malaysian ringgit as both their functional and presentation currency. They also properly recognize foreign exchange gains or loss and clearly explain their currency translation methods and policies. The only variation we see in our checklist is under exchange differences in other comprehensive income. KPJ fully complies with this requirement because they actively operate and report foreign subsidiaries. Conversely, LYC notes this as not applicable because they have very limited foreign activities, meaning fewer active disclosure are structurally required. In summary, both companies maintain a high level of reporting integrity. KPJ fully complies with comprehensive foreign operation disclosure, while LYC also fully complies relative to the smaller scale of their global activities. This demonstrates that challenging financial circumstances have not compromised their commitment to accounting standard transparency.